On paper, the global economy looks like it has been growing almost continuously. GDP charts trend upward. Headlines talk about recovery, resilience, and expansion. In the United States, real GDP in 2023 was more than 3 times larger than it was in 1980. In many advanced economies, total output today is the highest it has ever been. And yet, surveys consistently show that large portions of the population feel worse off, not better. This contradiction is not a perception problem, it's a measurement problem. GDP measures the total value of goods and services produced in an economy. It does not measure how that value is distributed, how secure people feel, or whether daily life is becoming more affordable. Historically, this distinction didn't matter as much because rising GDP usually coincided with rising living standards. Between 1945 and the early 1970s, productivity growth in the US averaged over 2.5% per year, and median wages rose alongside it. Growth felt real because it showed up in paychecks, housing access, and job security. That link began to weaken after the 1970s productivity slowdown. While GDP continued to grow, the benefits became uneven. Between 1979 and 2022, U.S. labor productivity rose by roughly 65%, but median hourly compensation rose by only about 18% after adjusting for inflation. Similar gaps appeared across Europe and Japan, especially after the 1990s. Output kept rising, lived progress slowed. This is why GDP growth can coexist with economic discomfort. An economy can produce more value overall while delivering less improvement to most people. Rising rents count toward GDP. Higher healthcare costs count toward GDP. Financial fees, asset transactions, and debt-driven consumption all increase measured output, even if they make life more expensive or fragile. Growth, in this sense, becomes a record of activity, not well-being. What makes this especially confusing is that GDP growth is often used as proof that complaints are exaggerated. If the economy is growing, the logic goes, conditions must be improving. But that assumption only holds if growth translates into purchasing power, security, and opportunity. When it doesn't, GDP becomes a misleading comfort signal, accurate in what it measures, but incomplete in what it represents. This is the foundation of the gap we're experiencing today. GDP continues to grow because economic activity continues. Life feels harder because the costs and benefits of that activity have shifted. And once that gap opens, it tends to widen unless something structural changes. If you value long-form economic explanations, grounded in real data and history, consider subscribing and joining the discussion in the comments. Because once GDP stops reflecting lived progress, the next question becomes unavoidable. What exactly is driving growth now, and who is it really serving? To understand why GDP can keep growing while life gets harder, we have to look at what kind of growth has dominated over the past few decades. The shift isn't subtle, and it isn't recent. It began in earnest in the late 1970s and early 1980s, when the link between productivity, wages, and prices started to break. Since then, growth has increasingly come from rising costs and asset values, not from rising pay or improved efficiency for most households. For much of the post-war period, growth showed up primarily through wages. When productivity increased, businesses produced more per worker, and a meaningful share of those gains flowed into pay. Between 1948 and 1973, real hourly compensation in the United States rose by roughly 90%, closely tracking productivity growth. That meant GDP growth translated into higher purchasing power and improved living standards. Growth felt tangible because it showed up where people actually lived. After 1973, that relationship changed. Productivity continued to grow, but wages slowed dramatically. At the same time, key household expenses began to rise faster than inflation. Housing, healthcare, education, and childcare all grew more expensive relative to income. Importantly, these rising costs still count as economic activity. Higher rents add to GDP. Higher medical spending adds to GDP. Larger student loans fund GDP-generating services. From a measurement standpoint, the economy is growing. From a household standpoint, cash flow is tightening. This is the critical shift. Growth moved from income-driven expansion to cost-driven expansion. Instead of households earning more and choosing to spend more, many households spend more simply to maintain the same standard of living. The economy records this as growth, even though lived progress is flat or negative. Between 2000 and 2020, U.S. GDP per capita rose steadily, yet median household income, adjusted for inflation, barely moved once rising housing and healthcare costs are accounted for. Asset prices amplified this shift. As interest rates declined over decades, the value of existing assets rose sharply. Home prices, equities, and financial assets appreciated faster than wages. That appreciation boosts measured wealth and economic output, but it also raises barriers to entry. Housing becomes harder to afford. Retirement becomes more dependent on market exposure. Younger generations face higher costs up front. even in a growing economy. What makes this especially deceptive is that cost-driven growth can persist for a long time. As long as households can borrow, governments can subsidize, and assets keep appreciating, GDP continues to rise. But this form of growth is fragile. It relies on balance sheets rather than income. It increases stress without creating resilience. And it slowly trains people to associate growth with pressure rather than progress. If this kind of long-form, data-grounded explanation is useful, consider subscribing and sharing your perspective in the comments. Because once growth comes from rising costs instead of rising wages, the next question becomes unavoidable. How long can that model function before households and the economy itself hit their limits? Once growth shifts away from wages and toward costs, another change follows almost automatically. Asset growth starts doing the work that income growth used to do. This is the stage where economies can look increasingly wealthy while everyday life becomes more constrained. The numbers improve, but the mechanism behind that improvement no longer expands opportunity in the same way. This shift accelerated after the 1980s, and even more sharply after the 2008 financial crisis. In response to repeated slowdowns, central banks relied heavily on lower interest rates and liquidity support. One predictable outcome of this policy environment was asset inflation. When borrowing becomes cheaper and capital searches for returns, the value of existing assets rises. Stocks, real estate, and financial instruments appreciate faster than the underlying economy. This boosts measured wealth and GDP-linked activity, even if productivity growth remains weak. Between 2009 and 2021, U.S. equity markets rose by over 400%, while real median wages grew far more slowly. Home prices increased at a pace that far outstripped income growth, particularly in major cities. These gains made balance sheets look stronger, but they didn't come from producing more value per worker. They came from revaluing what already existed. In other words, the economy grew richer without becoming much more productive. This matters because asset-driven growth changes who benefits and how. Asset appreciation primarily rewards those who already own assets. If you own property or financial investments, rising prices feel like progress. If you rely on wages to access housing, education, or security, rising asset values feel like a barrier. The same process that boosts aggregate wealth can simultaneously reduce mobility and increase precarity for non-owners. From a GDP perspective, this still counts as success. Real estate transactions, financial services, and higher rents all contribute to economic output. But from a lived perspective, the economy becomes more expensive without becoming more enabling. People work within a system where maintaining position requires greater leverage and exposure to financial risk. Growth continues, but it demands participation in asset markets rather than productive contribution. This is why asset growth can mask stagnation for long periods. As long as prices rise, confidence holds, consumption is supported by borrowing, governments point to strong headline numbers. But the underlying engine, productivity and income growth, remains weak. The economy becomes dependent on valuation rather than value creation. If this explanation resonates, consider subscribing and adding your perspective in the comments. These dynamics are easier to see once they're named, because when asset growth replaces real progress, the next problem isn't just inequality, it's fragility, and the system becomes far more sensitive to shocks than it appears. When growth is driven by asset appreciation rather than rising incomes and productivity, the economy doesn't just become unequal, it becomes fragile. Fragility is the condition where systems appear stable under normal conditions but respond poorly to stress. This is not a theoretical risk. It's a pattern that has repeated across advanced economies over the past several decades. The reason is structural. Asset-driven growth depends on confidence, leverage, and favorable financial conditions. Rising prices encourage borrowing. Borrowing supports spending. Spending sustains GDP. As long as interest rates remain low and asset values keep rising, the system holds together. But this form of growth lacks buffers. It does not generate enough income growth to absorb shocks without intervention. The period after the 2008 financial crisis illustrates this clearly. In many countries, GDP recovered faster than household balance sheets. Governments and central banks stabilized markets, but the recovery leaned heavily on financial channels. By 2019, U.S. GDP and stock markets had fully recovered. Yet labor force participation remained below pre-crisis levels, and wage growth was uneven. The economy looked strong, but resilience was thin. This fragility shows up most clearly when conditions tighten. When interest rates rise, asset values stop doing the work of growth. Borrowing becomes more expensive. Housing affordability worsens quickly. Consumption slows. Because wages haven't grown enough to compensate, households have little room to adjust. What looked like stability reveals itself as dependence. Between 2021 and 2023, as inflation surged and rates increased globally, this vulnerability became visible. Housing markets cooled sharply. Financial stress rose. Governments were forced to intervene again to prevent disorder. The issue wasn't that economies suddenly became weak. It was that they had been relying on asset growth for too long to generate momentum. Another source of fragility is synchronization. When growth is driven by financial conditions, many parts of the economy move together. Asset prices, credit availability, and confidence rise and fall in unison. This reduces diversification. In income-driven economies, different sectors can adjust independently. In asset-driven systems, shocks propagate faster and wider. This also explains why policy responses become more constrained over time. Each intervention stabilizes the present but increases reliance on future support. Debt levels rise, balance sheets stretch, the margin for error narrows. The economy becomes very good at avoiding immediate collapse, but worse at generating durable, self-sustaining growth. Importantly, fragility doesn't mean imminent crisis. It means heightened sensitivity. Small shocks produce large responses. Policy tools lose effectiveness. Confidence becomes harder to restore. The economy feels like it's always one step away from stress, even during periods of apparent calm. If this kind of long-form, evidence-based analysis helps you understand what's happening beneath the headlines, consider subscribing and sharing your thoughts in the comments. Because once growth depends on asset values and policy support, the next question becomes unavoidable. What happens to everyday life when that system starts to strain even without a full-blown crisis? The most telling sign that GDP growth has diverged from real progress isn't found in financial markets or policy statements. It's found in everyday life. This is the stage where people begin to feel that things are getting harder, even though the economy is supposedly doing well, not because of a single shock, but because pressure has been building quietly for years. One clear indicator is the widening gap between income growth and essential costs. Since the early 2000s, wages in many advanced economies have grown slowly in real terms, while core expenses have risen much faster. In the United States, for example, real median wages barely kept pace with inflation between 2000 and 2020, while housing costs rose far faster. According to the Federal Reserve, the median home price more than doubled between 2000 and 2022, while median household income increased by less than 50% over the same period. GDP recorded all of this as growth. Households experienced it as constraint. Healthcare and education followed a similar pattern. U.S. healthcare spending per capita rose from roughly $4,800 in 2000 to over $12,000 by 2022, far outpacing income growth. Higher spending boosts GDP, but it doesn't necessarily improve outcomes proportionally. For households, it means higher premiums, higher deductibles, and greater financial insecurity. Education costs climbed as well, increasing reliance on debt. Again, economic activity increased, but financial pressure intensified. This is why growth increasingly feels like maintenance rather than advancement. People are spending more just to stand still. Larger portions of income are absorbed by fixed costs, leaving less flexibility. Savings rates fluctuate. Debt becomes a coping mechanism rather than a choice. The economy remains active, but households operate closer to the edge. These pressures also reshape behavior. People delay major life decisions, homeownership, family formation, career changes, not because they lack ambition, but because the margin for error has shrunk. Risk tolerance declines. Mobility slows. The economy loses dynamism, not through collapse, but through caution. GDP continues to rise because transactions continue. Progress stalls because opportunity narrows. What makes this phase especially corrosive is that it's hard to articulate. There's no single metric that captures life feels harder. Official indicators may show low unemployment and steady growth, while stress, burnout, and insecurity rise. This disconnect fuels frustration and distrust. People feel unheard because the numbers don't reflect their experience. If this explanation aligns with what you're seeing, consider subscribing and joining the discussion below. These lived dynamics are central to understanding why growth no longer feels like progress. Because as everyday life tightens, the final question emerges. How long can an economy rely on growth that increases pressure rather than possibility? Once the gap between GDP growth and lived progress opens, it rarely stays stable. It widens. Not because conditions suddenly worsen, but because the mechanisms driving growth reinforce themselves in ways that compound pressure on everyday life. This is where the problem stops being cyclical and becomes structural. A key reason is path dependence. Economic systems adapt to the kind of growth they generate. When growth comes from asset appreciation, financial activity, and rising costs, institutions, policies, and incentives slowly reorganize around those sources. Over time, it becomes harder to shift back toward income and productivity-driven growth without disruption. The system learns to protect what is working on paper, even if it's failing people in practice. One example is housing. As home prices rose faster than incomes after the 1990s, housing became both a basic necessity and a financial asset. Policies increasingly prioritized price stability and homeowner wealth over affordability. By the 2010s, construction lagged population growth in many countries, reinforcing scarcity. Rising prices boosted GDP and household net worth for owners, but raised entry barriers for everyone else. Each year of appreciation made the next year's affordability problem harder to solve. The same dynamic appears in labor markets. When wage growth lags behind productivity and costs, employers rely more on flexibility contracting and cost control to remain competitive. This keeps employment high, but weakens security. Between 2000 and 2020, the share of income going to labor declined in many advanced economies, while the share going to capital rose. GDP captured the output, households felt the risk, financialization amplifies this effect. As returns from productive investment become harder to find, capital flows toward financial strategies that extract value rather than create it. Buybacks, mergers, and rent-seeking activities grow more attractive than long-term investment. These activities increase measured output and shareholder returns, but do little to expand opportunity. Over time, they reduce the economy's capacity to generate broad-based growth. Importantly, policy responses often unintentionally widen the gap. Measures designed to stabilize growth, low rates, liquidity support, targeted subsidies, help prevent collapse, but they also reinforce existing structures. They raise asset values faster than incomes. They keep the system functioning, but they don't reset it. Each intervention makes the next one more necessary. This is why the gap between GDP and lived experience tends to widen slowly, then suddenly feel permanent. The economy isn't failing outright. It's adapting in ways that prioritize continuity over renewal. And once those adaptations are in place, reversing them requires choices that are politically and economically difficult. If you're finding this kind of structural explanation useful, consider subscribing and sharing your perspective in the comments. These long-term dynamics rarely get discussed in real time, because when the gap keeps widening, the final question isn't whether growth will continue. It's whether growth, as currently structured, can still deliver a future that feels better rather than tighter. Once it's clear that GDP growth no longer translates into lived progress, the obvious question is why policy hasn't corrected the imbalance. After all, governments have tools, central banks have levers, and yet, despite decades of intervention, the gap persists. The reason isn't a lack of action. It's that most policy is designed to stabilize outcomes, not to restructure how growth is generated. Since the 1980s, macroeconomic policy in advanced economies has increasingly focused on managing volatility. Inflation targeting, financial stability mandates, and counter-cyclical interventions became the core framework. This approach was effective at preventing severe crises for long stretches of time, but it came with a trade-off. Policies optimized to smooth cycles are not well suited to rebuild productive capacity or restore wage-led growth. Consider monetary policy. Lower interest rates make borrowing cheaper, support asset prices, and encourage spending. These effects show up quickly in GDP, but they do not directly raise productivity or bargaining power for workers. In fact, prolonged low rates can have the opposite effect by encouraging capital to flow into existing assets rather than long-term investment. After 2008, policy rates in many countries remained near zero for over a decade. GDP recovered, markets surged, but productivity growth remained historically weak. Fiscal policy faces its own constraints. Investments that improve long-term progress, education quality, infrastructure, research, housing supply, take time to deliver results. Their benefits are diffuse and often political costs are immediate. By contrast, transfers and short-term stimulus boost demand quickly and show up in headline numbers. The incentive structure favors measures that protect near-term growth rather than reshape the economy's foundations. There is also a measurement trap. Because success is judged by GDP, employment, and market stability, policies that raise these indicators are labeled effective, even if they deepen structural problems. Rising home prices look like wealth creation. Expanding credit looks like growth. Policymakers are rewarded for preventing decline, not for changing direction. Over time, the definition of success narrows. This is why the gap between growth and lived experience persists even under active governance. The system isn't ignored, it's managed. But management is not transformation. Policies keep the engine running, yet avoid opening it up and redesigning how power, income, and opportunity flow through the economy. If this analysis helps clarify why fixes feel temporary, consider subscribing and sharing your thoughts below. Understanding policy limits is essential to understanding why this gap endures. Because once policy is constrained to managing symptoms rather than causes, the final issue comes into focus. What happens to trust, motivation, and social cohesion when progress no longer feels achievable? When GDP keeps growing but daily life keeps tightening, the damage is no longer just economic. It becomes psychological and social. This is the stage where people don't just feel poorer relative to the numbers. They begin to lose trust in the idea that the system is working for them at all. And once trust erodes, motivation follows. Historically, trust in economic systems was built on a simple expectation: effort would be rewarded with progress. That expectation held reasonably well in the decades after World War II. In the US and much of Western Europe, rising productivity translated into rising wages, expanding home ownership, and upward mobility. Between 1950 and 1970, a single income could often support a household, and each generation reasonably expected to live better than the last. Growth felt legitimate because it was broadly experienced. As that promise weakened after the 1980s, trust began to fray slowly. People still worked, still studied, still followed the rules, but the payoff became less predictable. By the 2010s, survey data across multiple countries showed declining confidence that hard work would lead to a better life. In the US, for example, the share of adults who believed their children would be better off financially than they were fell sharply after 2008. GDP recovered. Confidence did not. This erosion of trust changes behavior in subtle but powerful ways. Workers become more risk-averse, not because they lack ambition, but because failure has become more costly. Entrepreneurship declines. Job switching slows. People cling to stability even when it limits growth. The economy loses dynamism, not through collapse, but through caution. Growth continues, but innovation weakens. Motivation also shifts from creation to protection. Instead of asking how to build something new, people focus on how to avoid falling behind. Wealth accumulation becomes defensive. Education becomes a hedge rather than a pathway. Housing becomes a fortress asset rather than a place to live. These adaptations are rational responses to pressure, but they further entrench the system that caused the pressure in the first place. Social cohesion suffers as well. When numbers say success, but lived experience says strain, people stop trusting institutions and experts. Economic explanations sound detached. Official optimism feels dismissive. This gap fuels polarization, resentment, and withdrawal, not because people misunderstand the data, but because the data no longer speaks to their reality. Importantly, this erosion doesn't require mass unemployment or visible crisis. It happens precisely because the system continues to function while failing to deliver progress. GDP growth without lived improvement becomes corrosive. It undermines belief in the future, which is one of the most important inputs for long-term economic health. If this perspective resonates, consider subscribing and sharing your experience in the comments. These social dynamics often explain why economic systems become harder to repair over time. Because once trust and motivation erode, the final question becomes unavoidable. Can an economy sustain growth at all if fewer people believe in the future it promises? Once the gap between GDP growth and lived progress is wide enough, it doesn't just persist. It begins to reinforce itself. This is the stage where the problem stops being the result of past decisions and becomes the product of present incentives. The system starts reproducing the very conditions that created the gap in the first place. One reason is feedback loops and capital allocation. When returns from asset ownership consistently outperform returns from work or productive investment, capital naturally flows toward assets. This has been visible since at least the 1990s, and sharply after 2008, when low interest rates and weak productivity made financial returns more attractive than real investment. As capital concentrates in assets, prices rise faster than incomes, widening the gap further. Each cycle makes the next one harder to break. Labor markets reinforce this dynamic. When households are under pressure, they become more risk-averse. They prioritize job security over innovation, income stability over experimentation. This reduces job switching, entrepreneurship, and wage pressure. In the US, job-to-job mobility declined significantly after 2000 and never fully recovered after the financial crisis. Lower mobility weakens bargaining power, which slows wage growth, even when GDP rises. Policy feedback loops add another layer. Because GDP growth and market stability are still treated as primary success indicators, policies that support asset values are rewarded. When markets wobble, intervention is swift. When living standards stagnate, responses are slower and more fragmented. This asymmetry teaches markets and institutions where protection lies, further embedding the existing growth model. There's also a cultural reinforcement. As people adapt to tighter conditions, expectations reset. Younger generations plan around constraints rather than opportunities. Businesses design models around rent extraction rather than expansion. Governments frame ambition in terms of resilience and sustainability instead of advancement. None of this looks like failure in isolation, but together it locks the system into low progress equilibrium. Over time, this self-reinforcing loop changes what growth means. Growth becomes something that happens above people rather than through them. GDP rises because systems are efficient at extracting value, not because they're enabling broader participation. The economy keeps moving, but fewer people feel carried forward by it. This is why the gap is so difficult to close once it's established. Fixing it isn't about boosting growth. It's about changing the structure of incentives, which is far more challenging politically and economically. Without that shift, growth continues to widen the divide it's supposed to solve. If this analysis helps connect the dots, consider subscribing and sharing your thoughts in the comments. These feedback loops are invisible until they're named, because once the gap becomes self-reinforcing, the final issue isn't whether GDP will keep growing. It's whether growth, as currently structured, can ever translate back into real progress. Once the gap between GDP growth and lived progress is wide enough, it doesn't just persist, it begins to reinforce itself. This is the stage where the problem stops being the result of past decisions and becomes the product of present incentives. The system starts reproducing the very conditions that created the gap in the first place. One reason is feedback loops in capital allocation. When returns from asset ownership consistently outperform returns from work or productive investment, capital naturally flows toward assets. This has been visible since at least the 1990s and sharply after 2008, when low interest rates and weak productivity made financial returns more attractive than real investment. As capital concentrates in assets, prices rise faster than incomes, widening the gap further. Each cycle makes the next one harder to break. Labor markets reinforce this dynamic. When households are under pressure, they become more risk-averse. They prioritize job security over innovation, income stability over experimentation. This reduces job switching, entrepreneurship, and wage pressure. In the US, job-to-job mobility declined significantly after 2000 and never fully recovered after the financial crisis. Lower mobility weakens bargaining power, which slows wage growth. Even when GDP rises, policy feedback loops add another layer. Because GDP growth and market stability are still treated as primary success indicators, policies that support asset values are rewarded. When markets wobble, intervention is swift. When living standards stagnate, responses are slower and more fragmented. This asymmetry teaches markets and institutions where protection lies, further embedding the existing growth model. There's also a cultural reinforcement. As people adapt to tighter conditions, expectations reset. Younger generations plan around constraints rather than opportunities. Businesses design models around rent extraction rather than expansion. Governments frame ambition in terms of resilience and sustainability instead of advancement. None of this looks like failure in isolation, but together it locks the system into low progress equilibrium. Over time, this self-reinforcing loop changes what growth means. Growth becomes something that happens above people rather than through them. GDP rises because systems are efficient at extracting value, not because they're enabling broader participation. The economy keeps moving, but fewer people feel carried forward by it. This is why the gap is so difficult to close once it's established. Fixing it isn't about boosting growth. It's about changing the structure of incentives, which is far more challenging politically and economically. Without that shift, growth continues to widen the divide it's supposed to solve. If this analysis helps connect the dots, consider subscribing and sharing your thoughts in the comments. These feedback loops are invisible until they're named, because once the gap becomes self-reinforcing, the final issue isn't whether GDP will keep growing, it's whether growth, as currently structured, can ever translate back into real progress. At this stage, the contradiction reaches its clearest form. GDP can continue to rise even as well-being, security, and opportunity decline for large parts of the population. This isn't a failure of the data. It's a reflection of what GDP is designed to measure, and what it deliberately leaves out. GDP counts economic activity, not economic outcomes. It measures how much money changes hands, not whether that exchange improves lives. When rents rise because housing is scarce, GDP goes up. When healthcare costs increase because systems are inefficient, GDP goes up. When households take on more debt to maintain living standards, GDP goes up. None of these outcomes signal progress, yet all of them register as growth. This distinction became more pronounced after the 1990s, as services, finance, and asset-linked activities grew faster than manufacturing and productivity-driven sectors. By the 2010s, a significant share of GDP growth in advanced economies came from sectors where higher prices reflected scarcity, complexity, or bargaining power rather than efficiency. The economy appeared to be expanding, but much of that expansion was frictional rather than generative. Well-being, by contrast, depends on flows, not totals. It depends on wages relative to costs, time availability, security, and predictability. These are not captured by GDP. A household earning the same real income while paying more for housing, healthcare, and education experiences decline, even if aggregate output rises. When this pattern repeats across millions of households, GDP and lived reality diverge systematically. This helps explain why dissatisfaction rises during periods officially labeled as strong economies. Surveys across OECD countries show that perceptions of economic insecurity increased in the years following 2010, despite steady GDP growth and falling unemployment. People weren't misreading the economy. They were responding to conditions GDP doesn't measure. The danger here is misdiagnosis. If policymakers treat rising GDP as evidence that systems are working, they may overlook mounting strain. Solutions focus on sustaining activity rather than restoring balance. Growth becomes an end in itself, detached from its original purpose, improving human outcomes. This is why the gap between GDP and lived experience isn't just frustrating, it's destabilizing. When official success metrics contradict daily reality, trust erodes. People disengage from economic narratives and institutions. Growth continues, but legitimacy fades. If this framing helps clarify why the numbers feel disconnected from life, consider subscribing and sharing your thoughts below. Understanding what GDP can and cannot tell us is essential to understanding the moment we're in. Because once we recognize that GDP can grow without improving lives, the final question becomes unavoidable. What would an economy optimized for real progress actually look like? If GDP can keep growing while life gets harder, then fixing the problem isn't about chasing higher numbers. It's about changing what growth is built on. Real progress doesn't come from more activity alone. It comes from activity that expands capability, security, and opportunity. History shows this clearly, even if modern policy often forgets it. Periods where growth felt broadly beneficial shared a few structural traits. First, productivity gains, translated into income gains. Between 1948 and 1973, U.S. productivity and median compensation rose together, and similar patterns appeared across Western Europe and Japan during their post-war expansions. Growth worked because it increased what households could do with their income, not just what the economy could record as output. Second, investment flowed into capacity, not just assets. Infrastructure, housing supply, education quality, and research absorbed large shares of capital. These investments didn't just boost GDP temporarily, they raised the economy's long-term ceiling. By contrast, since the 1990s, and especially after 2008, a growing share of investment has gone toward asset appreciation and financial engineering. That keeps growth alive on paper, but it doesn't rebuild the foundations of progress. Third, real progress required room for risk at the household level. When people can afford to change jobs, start businesses, or invest in skills without catastrophic downside, economies stay dynamic. As fixed costs have risen faster than income since the early 2000s, that room has shrunk. Restoring it isn't about motivation, it's about balance sheets, affordability, and security. Crucially, none of this is fast or easy. Shifting from cost and asset-driven growth back to income and productivity-driven growth takes time. It often requires accepting short-term discomfort in exchange for long-term resilience. That's why it's politically difficult. GDP-focused systems reward immediate stability. Real progress demands structural change. This is also why the gap between GDP and lived experience won't close on its own. Left unchecked, the system keeps optimizing for what it already measures. Growth continues, pressure remains, and dissatisfaction deepens. The danger isn't collapse, it's permanence. If you want to understand where this gap begins, especially the quiet phase where damage accumulates before anyone panics, watch our previous video. The hidden stage between boom and bust, where most damage happens. It explains how economies drift into this condition long before it shows up in daily life. If you value long-form, data-grounded economic analysis that goes beyond headlines and surface-level explanations, consider subscribing, sharing your perspective in the comments, and staying with us for future deep dives into how economies really work.